The 2026 housing crash is no longer something people are speculating about. It has arrived. In several cities, foreclosure rates are already piling up at levels that feel eerily similar to the darkest moments of 2008. But this story isn't just about home prices dropping. It's about watching entire local economies begin to come apart right in front of us. What's most unsettling is how many people still insist this is just a short-term pullback that will quickly correct itself. The reality on the ground tells a very different story. Today on Discover the Cities, we're taking you through 10 cities where property values aren't easing down slowly. They're collapsing. In some places, prices have fallen by half or even more. We're going to show you exactly where the housing bubble finally burst, where homeowners are now trapped, and why, for countless families, the American dream has been quietly taken away. Stick with us. Be sure you're subscribed to Discover the Cities and hit the like button, because what you're about to see could help you avoid a very costly decision. Now, let's begin the countdown. Number 10. Cape Coral, Florida. When you first arrive in Cape Coral, it looks like a postcard version of Florida brought to life. Miles of canals, endless sunshine, waterfront neighborhoods, and the added appeal of no state income tax. It all feels like the perfect formula. At a glance, it seems ideal. But that illusion starts to crumble the moment you look at the housing data. In less than 2 years, the median home price here has dropped from roughly $465,000 to about $260,000. That's a decline of more than 40%, and the fall hasn't leveled off. Prices continue to slide, leaving homeowners stunned by how fast the market has turned. The real shock, though, comes when you examine insurance costs. Homeowners in Cape Coral aren't just dealing with rising premiums. Many are being dropped entirely. Florida's insurance system is under extreme pressure, and families here are feeling the consequences. It's now common to see annual homeowners insurance quotes between $8,000 and $10,000 for houses valued around $300,000. One local couple watched their insurance premium double at the same time. Their home's appraised value fell more than $100,000 below what they originally paid. What was supposed to be affordable coastal living has turned into a financial trap, a fixed expense that keeps climbing while the underlying asset keeps losing value. Hurricane Ian tore through Lee County and left damage that still hasn't fully healed. Rebuilding costs skyrocketed. Some contractors never completed their work. Government assistance moved slowly. Meanwhile, homeowners associations continued charging dues, and special assessments began showing up just as families were already stretched thin. Homes now sit on the market for 6 months or longer. Price cuts aren't small tweaks. They're steep, desperate drops aimed at attracting any serious buyer. One waterfront home that originally listed near $899,000 eventually sold in the low $400,000s after months of stagnation. Even renting doesn't offer much relief. While rents have started to cool slightly, they remain high enough to strain household budgets. Cape Coral has become a place where insurance costs, repair bills, and constant uncertainty weigh heavily on every financial decision. If you live in Cape Coral, or ever thought about buying here, share your experience in the comments. The numbers coming out of this part of Florida aren't just local trouble. They're a warning sign for coastal housing markets across the entire country. Number 9. Austin, Texas. You arrive in Austin expecting nonstop growth, shiny tech campuses, legendary music venues, and a city that seemed destined to keep booming forever. For a while, that narrative felt unbeatable. During the pandemic surge, home prices skyrocketed by more than 90% as tech companies expanded, and remote workers poured in from across the country. Then the momentum broke. By mid-2026, the median home price had dropped from about $575,000 to just under $385,000. That's roughly a one-third decline, with additional weakness still looming ahead. The reasons behind the shift are hard to miss. Major employers have cut staff. Well-known tech firms slowed hiring or announced layoffs. The high-rise apartment towers that once symbolized Austin's new prosperity are now dealing with elevated vacancy rates and heavy move-in incentives. Owners who purchased newly built condos at peak prices are discovering there simply isn't enough demand at those levels. With mortgage rates sitting above 7%, enthusiasm for pricey urban living has cooled dramatically, convincing buyers to spend close to $1 million for small lots, limited yard space, and sleek finishes that already feel outdated has become a serious challenge. The days on market data tells the story clearly. Homes that once sparked bidding wars over a single weekend now linger for 4 to 6 months. A newly built home in East Austin that originally listed near $799,000 is now priced closer to $499,000, and it's still waiting for a buyer. Homeowners associations remain active and expensive, even when shared amenities go largely unused. Some buildings have introduced new technology fees or special charges just to keep budgets balanced while units sit empty. On top of that, extreme heat, recurring concerns about the power grid, and rising insurance costs have added another layer of uncertainty. Utility bills are higher. Water limitations and infrastructure strain are now part of everyday conversation. The migration wave that once fueled Austin's growth has slowed, and in some cases, reversed. A number of residents who moved in during the height of the hype are quietly relocating again, often to more affordable regions. If you, or someone you know, bought in Austin near the peak, share how the numbers look today. A city once promoted as the next great tech capital is now learning what happens when growth expectations race far ahead of economic reality. Number 8. Boise, Idaho. Boise was once seen as a quiet win in the Mountain West, a place people moved to for open space, natural beauty, and housing that still felt attainable. For years, it flew under the radar. Then national attention arrived, and everything changed. Between 2020 and 2022, home prices surged by more than 70% as buyers from expensive coastal markets rushed in, eager to cash out and start fresh. By mid-2026, that boom had reversed sharply. Home values have dropped close to 50% from their peak in many areas, with median prices sliding from the mid-$500,000 range down toward the high 200,000s. The reversal has been swift and painful. At the heart of the problem is a mismatch between prices and local incomes. Many buyers paid far more than the regional economy could realistically support. Remote workers arrived with big city salaries, but those jobs were never deeply tied to Boise itself. When tech companies began pulling back and remote work policies tightened, a portion of those higher earners moved on. What remained were home prices inflated by temporary demand, paired with wages closer to Boise's historical norms. New subdivisions spread along the edges of the city, filled with modern homes, built for nonstop growth that has since slowed dramatically. Some of those properties have already slipped into foreclosure. Others are being sold at significant losses. Stories are circulating of individual owners losing 6 figures in equity on speculative purchases that were meant to be quick flips. The rental market hasn't offered much protection either. While rents have started to ease as vacancies increase, the decline hasn't been enough to offset higher interest rates and rising operating costs faced by investors. At the same time, wildfire risk and shifting climate patterns are beginning to affect insurance pricing. In certain areas, premiums have steadily climbed, adding yet another fixed expense to already strained household budgets. Locally, tensions are rising. Longtime residents who were frustrated by the rapid transformation during the boom years now watch as parts of that new construction sit underused or empty. If you moved to Boise hoping it would be a safe haven and discovered something very different, share your experience in the comments. Boise is a clear example of how quickly a so-called hidden gem can turn into a cautionary tale when investment arrives faster than sustainable job growth. Number 7. Las Vegas, Nevada. Las Vegas has never been afraid of risk. But the biggest bet this time wasn't placed inside a casino. It was made in the neighborhoods surrounding the valley. During the recent housing boom, median home prices surged toward $475,000 as investors, second home buyers, and new residents all chased a limited supply. Then the tide turned. By 2026, that median price had fallen into the high 200,000s, representing declines of up to 60% in certain segments. And many analysts believe the market still hasn't hit a true bottom. A major driver of the reversal came from the explosion of short-term rentals during the post-pandemic surge. Investors snapped up single-family homes and condos, betting on nonstop tourism and strong nightly rental income. But as travel patterns shifted, competition increased, and visitors became more budget-conscious, those properties started losing their appeal. Occupancy rates dropped. For many owners, the numbers stopped working. Rental income no longer covered mortgages. property taxes, and ongoing maintenance. At the same time, the broader economic environment in Las Vegas has grown more complicated. Water scarcity concerns and record-breaking heat have drawn national attention. Insurance costs have climbed as environmental risks become harder to overlook. Utility bills during the hottest months now put real pressure on household budgets. On the outskirts of the city, newer subdivisions tell their own story. Quiet streets lined with partially completed projects suggest growth plans that no longer match today's demand. Meanwhile, workers in hospitality and entertainment, the backbone of the local economy, are facing their own financial strain. Wages across many service jobs haven't kept pace with housing costs, even after recent corrections. As a result, some homeowners who bought late in the cycle are now underwater, owing more on their mortgages than their homes would realistically sell for today. Las Vegas has always been known for reinvention, but this housing reset is forcing a much tougher calculation. If you've thought about buying or investing here, it's worth asking whether the potential upside truly balances the growing layers of risk. And if you've lived through a real estate swing in this city that never sleeps, share your experience below.
Number 6. Phoenix, Arizona. In Phoenix, the pressure isn't just coming from the desert heat. It's showing up clearly in the housing numbers. At the height of the recent boom, median home prices across the metro climbed into the low $600,000 as buyers poured in from more expensive states. Since then, the reversal has been sharp. Many estimates now suggest prices are down close to 50% from those extremes, pulling typical home values back toward the low $300,000 range. For homeowners who bought near the top, this isn't an abstract market correction. It's the difference between having equity and being financially stuck. Looking back, the ingredients of the boom are easy to spot. Investors rushed in. Remote workers arrived assuming flexibility would last forever. Builders rolled out massive subdivisions across the valley. Homes went up faster than schools, medical facilities, and retail centers could keep pace. Once interest rates climbed and borrowing costs reset, demand cooled quickly. Purchases slowed to a crawl. Many listings now sit on the market for 5 months or more. Sellers are increasingly forced to accept offers far below last year's prices, often sweetened with closing cost credits, mortgage rate buydowns, or extra concessions on appliances and upgrades just to secure a deal. Environmental factors are adding another layer of strain. Phoenix regularly endures long stretches of triple-digit temperatures, pushing electricity usage and utility bills higher. Power providers have raised rates, pointing to rising demand and infrastructure stress. At the same time, long-term water availability from the Colorado River is under closer scrutiny, with some new developments facing stricter limits and more intensive reviews before receiving approval. Insurance is also becoming more complicated. Providers are reassessing risk in hotter, drier regions, leading to higher premiums, larger deductibles, and new exclusions tied to extreme heat and storms. For households already stretching their budgets to keep up with mortgage payments, those added costs can be significant. Investors who once penciled in strong cash flow projections are now revisiting their numbers and finding uncomfortable gaps. Phoenix was promoted as a more affordable alternative to coastal markets, with sunshine and space as major selling points. But many recent buyers are learning that true affordability depends on stable utility bills, manageable insurance costs, realistic home prices, and reliable employment, not just the initial purchase price. As a result, some families who once planned to move here for opportunity are now hitting pause and reconsidering. If Phoenix is a market you've been watching, share in the comments whether this correction has changed how you view the valley.
Number 5. San Francisco, California. San Francisco was once the ultimate symbol of unstoppable tech wealth. For years, the idea that home prices here could fall in any serious way felt almost impossible. Real estate in the Bay Area was supposed to be immune. But over the past few years, that assumption has been steadily dismantled. From a peak median price near $1.6 million, home values in many parts of the metro have dropped to under $900,000. In certain segments, that represents a correction of more than 50%. Even after that decline, San Francisco remains one of the most expensive housing markets in the country. But what has changed is direction, and just as importantly, mindset. The psychology of both buyers and sellers has shifted. The forces behind the downturn are layered and interconnected. A long-term move toward remote and hybrid work has left many downtown office buildings underused. Some companies downsized their footprints. Others relocated entirely. Commercial vacancies rose, and the surrounding residential areas felt the ripple effects as restaurants, shops, and services that depended on daily office traffic began to thin out or shut down. Buyers who once paid a premium to live close to major tech headquarters are now rethinking that value. When teams are scattered and in-office schedules are optional, proximity matters less. Neighborhoods that relied on dense office crowds to sustain local businesses have struggled to adjust, and in some cases, they haven't survived the transition. Homeowners who stretched their finances to buy small houses or condos at peak prices are now facing a different kind of pressure. Property taxes, HOA dues, and insurance costs didn't fall nearly as fast as home values. In some buildings, monthly association fees run into the thousands, even as major upgrades remain unfinished. Seismic retrofits, aging plumbing, and elevator modernization all demand continued investment, creating a tough dilemma. Selling locks in a loss. Holding on means paying more out of pocket. Insurance has added another complication. Wildfire risk in nearby regions has reshaped the coverage landscape. Some insurers have tightened underwriting standards or pulled back from certain areas altogether, forcing homeowners to search for new policies that often come with higher premiums or reduced protection. At the same time, broader concerns are influencing buyer behavior. Public safety issues, visible homelessness, and widespread retail closures have become part of the decision-making process. Together, rising fixed costs, shifting work patterns, and softer demand are pushing more owners to consider selling, even if that means accepting a much lower price than they once expected. San Francisco's story is no longer just about explosive growth and extraordinary returns. It's about what happens when tech wealth and real estate speculation collide with real-world limits, aging infrastructure, and affordability pressures on the local workforce. The city is now facing deeper questions about who can afford to stay, who chooses to leave, and what kind of economy can realistically be sustained going forward. If you followed this market up close or from afar, share how your perspective has changed over the last few years, and whether you see what's happening as a temporary reset or a lasting realignment.
Number 4. Myrtle Beach, South Carolina. At first glance, Myrtle Beach looks like the definition of a classic coastal escape. Wide, sandy beaches, resort-style high-rises, golf carts rolling through town, and a constant stream of tourists. During the pandemic boom, it became a hotspot for investors. Buyers from all over the country rushed in, snapping up beachfront condos and short-term rentals, convinced that steady tourism would always cover the costs. Since 2023, that confidence has been seriously shaken. In many parts of the market, home values have fallen by more than 45%, turning what looked like a strong surge into a sharp downturn. For many owners, that drop erased far more equity than they ever expected to lose. The underlying formula for trouble is familiar. Too many investors pursued the same short-term rental strategy. Too many nearly identical properties hit the market at the same time. And expenses kept climbing. In some condo buildings, homeowners association fees now reach hundreds of dollars each month. Even properties with aging systems and long-delayed maintenance still require owners to pay hefty dues, special assessments, and repair costs, despite seeing their equity shrink. What once appeared to be comfortably positive cash flow on paper is now hovering close to break-even, if not worse. Insurance has added another layer of pressure. Growing concerns over hurricanes and flooding have pushed premiums higher, and in some cases, insurers have reduced coverage or dropped policies altogether after relatively minor events. For retirees on fixed incomes or investors operating on thin margins, a sudden spike in insurance costs can quickly turn a property from an asset into a liability. Despite these challenges, new developments continue to move forward in certain coastal areas. That ongoing construction adds to oversupply, even as existing units struggle to stay occupied. The imbalance pushes prices down while fixed costs remain stubbornly high. Meanwhile, locals have dealt with heavier traffic and strained infrastructure without necessarily sharing in the financial upside of the boom years. Many service workers who keep the tourism industry running now live farther inland, commuting into a city where countless balconies sit dark during the off-season. If your idea of a beach town investment included reliable income and long-term appreciation, Myrtle Beach offers a clear reminder that coastal real estate comes with risks far beyond postcard views. Let us know in the comments if you've watched this market shift from opportunity to challenge, and whether you believe it can find its balance again. Number 3. Salt Lake City, Utah. Salt Lake City suddenly found itself in the national spotlight as a more affordable alternative to the West Coast. For a while, it seemed like the ideal middle ground. Mountain views, a growing tech scene, and home prices that still looked reasonable compared to California. During the boom from 2020 to 2022, values jumped by roughly 75%. Since then, the reversal has been just as dramatic. Prices are now down more than 40% from their peak, pulling median home values from around $620,000 into the mid-$300,000 range in many neighborhoods and forcing recent buyers to rethink their assumptions. At the height of the surge, remote workers and newcomers from higher-cost states competed aggressively, often offering well above asking prices for fairly modest homes. Builders responded quickly, rolling out new developments in suburban areas and foothill communities, confident demand would stay strong. But once interest rates climbed and corporate hiring cooled, the mood shifted. Homes that once sparked bidding wars now sit on the market for weeks or even months. Sellers are increasingly using phrases like motivated and open to concessions, signaling a willingness to negotiate in ways that would have seemed unthinkable just a year earlier. The rental market has softened as well, especially downtown and near university areas. Property managers are offering free rent periods, gift cards, reduced deposits, and other incentives to fill units. For landlords who bought during the boom expecting nonstop demand and rising rents, those concessions cut straight into profits. Some smaller investors are now quietly looking for an exit, even if it means accepting a loss in the short term. There are also environmental and structural considerations adding pressure. Wildfire risk in the foothills has become more prominent as summers grow hotter and drier. Earthquake risk, once rarely discussed outside of technical circles, is now showing up more often in insurance discussions and long-term planning. On top of that, homeowners associations in many suburban neighborhoods have tightened enforcement, adding fees and creating friction over issues like parking, landscaping, and rental restrictions. Salt Lake City's rapid shift, from overlooked value to overheated market to sharp correction, has been eye-opening. It's forcing residents, investors, and local planners to ask harder questions about how much growth the region can realistically handle and what kind of housing and infrastructure it truly needs. If you live in the area or have considered moving there, share how recent housing trends have influenced your thinking, and whether you see this moment as an opportunity or a warning. Number 2. Naples, Florida. For years, Naples has embodied a very specific vision of Florida luxury. Pristine neighborhoods, gated golf communities, and waterfront homes made it a magnet for retirees and second home buyers from across the country. At the height of the recent boom, average home prices in some areas climbed to around $1.1 million. Since then, that picture has changed dramatically. Values have dropped hard, with many properties now selling for roughly half of what they once commanded. In some high-end condo buildings, the declines have been even steeper, challenging the long-held belief that prime coastal real estate only goes in one direction. Severe storms played a major role in exposing how fragile that assumption really was. Hurricane Ian, along with other significant weather events, caused widespread damage and sent rebuilding costs soaring. At the same time, flood and wind risks moved from abstract concerns to daily realities. Since 2023, insurance premiums in Collier County have climbed sharply, sometimes tripling over just a few renewal cycles. Policies that once cost a few $1,000s a year now often reach well into 5 figures, putting serious pressure on retirement budgets and investment plans. As private insurers pulled back or tightened standards, demand surged for Citizens Property Insurance, the state-backed insurer of last resort. Some homeowners faced delays, stricter requirements, or limited coverage options. The result is a growing number of households paying extremely high insurance costs or accepting less than ideal protection, while still covering property taxes and association fees based on values that no longer reflect current market reality. For buyers who entered at the peak, that combination can feel like getting squeezed from both sides. Naples is also known for its dense network of gated communities and tightly managed homeowners associations. Monthly fees can be substantial, and special assessments often arrive on top of them. Major projects, such as seawall reinforcement, roof replacements, or clubhouse renovations, frequently translate into large one-time charges. For people who bought at peak prices expecting low-maintenance coastal living, the mix of falling values and rising fixed costs has been a shock. Some owners who once planned to pass these homes down to family members are now rethinking that future and considering selling instead. The golf courses, clubhouses, and resort-style amenities still look impressive on the surface. But behind the scenes, more listings are quietly hitting the market as owners try to exit before conditions worsen further or another major storm arrives. If Naples was once your ideal retirement destination, this market offers a sobering reminder to look beyond the scenery. In hurricane-exposed luxury areas, long-term affordability is shaped not just by purchase price, but by climate risk, insurance costs, and association rules, all of which can change faster than many buyers expect. Number 1. Palm Springs, California. We end our journey in Palm Springs, a desert city that became a global icon of mid-century design and sun-soaked escape. For years, it symbolized style, leisure, and effortless appreciation. During the pandemic boom, home prices here surged to staggering levels, with median values approaching $1.2 million in some reports by early 2022. But by 2026, that story had flipped. In many neighborhoods, median prices have fallen into the high $500,000, a drop of more than 50%. In areas dominated by short-term rentals, the losses have been even deeper, erasing years of paper gains almost overnight. During the height of the boom, buyers from Los Angeles and other high-cost markets rushed in. Older ranch homes and bungalows were snapped up, renovated, and transformed into vacation rentals with curated interiors and premium nightly rates. For a short time, the strategy worked. Bookings were strong, social media amplified the lifestyle, and Palm Springs felt unstoppable. Then conditions changed. Heat waves grew more intense. Tourism patterns shifted. Local governments tightened short-term rental regulations. New permit caps, stricter enforcement, and heavier fines dramatically altered the financial equation. Some owners discovered their permits could no longer be renewed under updated rules, cutting off the income streams they relied on to cover mortgages and renovation costs. Insurance quickly became another major strain. As wildfire risk increased across the region, several large insurers reduced their exposure in California or exited certain markets entirely. Many homeowners were left scrambling for coverage, often facing higher premiums, fewer options, larger deductibles, and expanded exclusions. At the same time, energy costs continued to rise in a desert climate where air conditioning isn't optional, it's essential. Water has added yet another expense. Restrictions and penalties for overuse have become more common, even in a city where pools, fountains, and lush landscaping were once major selling points. Together, these pressures have reshaped the economics of ownership. Palm Springs still looks stunning in photos. But behind the visuals, the numbers tell a very different story. Homes that once seemed like reliable stores of wealth are now harder to sell anywhere near past prices. Properties purchased as rental investments often struggle to generate enough income to justify their ongoing costs once utilities, maintenance, management, insurance, and taxes are factored in. Streets that once buzzed during peak seasons now show more for sale signs and fewer fully booked driveways. Palm Springs illustrates what happens when trend-driven demand, speculative buying, and environmental risk collide. It forces buyers to confront a difficult question. How much is a lifestyle really worth when it comes with rising costs and growing regulatory uncertainty? If you've been watching this market evolve, let us know whether you believe Palm Springs can reinvent itself yet again, or whether this correction represents a more permanent reset in how desert luxury is valued. And with that, our journey comes to an end. From investor-driven turbulence in Cape Coral and Boise, to deep corrections in Las Vegas and Phoenix, to luxury pullbacks in San Francisco, Naples, and Palm Springs, One pattern stands out clearly. The 2026 housing downturn is not a mild adjustment. In many of these cities, it's a full-scale reset, one that exposes just how fragile some of the most celebrated markets really were. If you're thinking about buying in any of these areas, relying on old price charts or sales slogans isn't enough anymore. You have to look deeper at insurance costs, long-term climate risk, job stability, local policy changes, and whether the people who keep a city running can still afford to live there. If you already own in one of these markets, you're experiencing that reality every day. If this deep dive helped you see beyond the headlines, take a moment to like this video, share it with someone considering a major move, and subscribe to discover the cities so you don't miss our next investigation. Let us know in the comments which city surprised you most, and which market you'd like us to examine next.